Are ugly, greedy property investors really the cause of sky-high property prices? Well, if you believe the media, that would be the case. But the latest Australian Taxation Office statistics reveal some numbers that will give you some insight into how many properties investors really own. We're also going to unravel the impact of the government policies over the last couple of years that are now making property investors flee. This week, Dr. Andrew Wilson and I are also going to talk about the regional property markets and the RBA's decision that's coming up next week about interest rates. So if you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so we can keep you up to date each time a new show comes out. At a time when inflation is sky high and everyday Australians are feeling the pinch, and properties are both low in supply and high in price, many fingers are pointing at property investors, and if you believe the media, so-called greedy property investors are to blame for the market's financial woes. After all, aren't these greedy investors buying up all the affordable properties and leaving little for the rest? Well, the latest Australian Taxation Office statistics reveal some numbers which will help give you an insight into how rich property investors really are, how many properties they really own, and I'll be discussing that today in this week's Property Insider Chat with Dr. Andrew Wilson. We're also going to talk about what the RBA would be thinking about with the next interest rate decision coming up, and we'll also be talking about what's happening to regional property markets around Australia. Hi, Andrew.
Yes, good morning, Michael. There's actually a lot to discuss today, isn't there? I think the issues around the policy position from governments and policymakers towards those small-scale investors is really concerning. Of course, we now have a really dreadful rental market from the tenant's perspective. Maybe it's the consequence of a lot of these policy positions now that we are seeing with these rents continuing to skyrocket. Way too much demand, particularly with international borders open now, and continued downward pressure on new building, which is only being exacerbated by high building costs now. At the end of the day, it's very difficult to secure a roof over your head, particularly if you're a tenant, and only likely to get harder. But one would think that policymakers would have realised that by constraining investor activity, you're only going to mean fewer investment properties and higher rents. But maybe that's the plan, Michael, and over the long term is to get rid of the small-scale investor.
Well, the Australian Taxation Office releases statistics about how many people report property investments in their tax returns. The latest statistics for the financial year 2020-21 were recently released. And it's interesting, Andrew, despite the blogs, the podcasts, the YouTube videos, the percentage of people who own one property investment really hasn't changed over the decades. It's about 71, 72%. 18% own two investment properties. And of all the 2.2 million property investors in Australia, there's only 19,920 who own six or more properties, less than 1%. In other words, most property investors are ordinary mums and dads who are looking to secure their financial future. But Andrew, the other statistic that concerned me was how few new investors are getting in the market. But when you see everything that's been thrown at them, that's really not a surprise, is it?
No, it's not. And of course, we've come through a tumultuous period, Michael, over the last 4 or 5 years. We've had a real roller coaster of activity, and it's been a shortened cycle, which of course acts as a disincentive for those looking for investment properties. Maybe we're starting to see the potential for clear air now, but really this is almost 4 years on from the easing we had in 2018 following the big boom in 2017. But yeah, look, it's I think there is those issues with the cycle being much shorter recently, and all those outside factors that have influenced housing market activity and the economy. But going forward, of course, higher interest rates are now acting as an anchor for investors and ball and chain to investors increasingly as they rise, perhaps offset by skyrocketing rents. But still, there are those policies that have been introduced that certainly are a negative in terms of incentives for investors. And you would have thought, don't we need more investors, not fewer investors? But Maybe that's the point. This is an ideological play to some degree to get rid of that very strong private sector market.
Well, as this chart shows, back in the 2009, 2010, there were close to 70,000 net new investors. Some people sold properties, others got in the market, and then it was 60,000, 80,000. But in the last couple of years, really the numbers have been much, much less than that. But let's just look at what they've had to put up with. Going back, APRA's macro-prudential controls, the Haynes Royal Commission, APRA limiting the interest-only lending, the extra buffers APRA put in place. But more recently, Andrew, each of the state governments have come up with tenancy reforms, things that seem to be favouring tenants more. I think investors are not happy that they're losing control.
No, and look, the bottom line is you can fiddle all you like if you're a state government policymaker because you're under pressure from the noisy part of the electorate. And they're probably, you could describe as the have-nots to some degree. And I guess, if you're in public service, you want to look to ease the load that those that aren't doing it as well as others. But at the end of the day, you likely create more problems than you solve. And create even more imbalances. The bottom line is quite clearly we have too many people and not enough houses or units. X can't go into Y in those circumstances, and that means higher rents particularly, and we're seeing that now with some really crazy increases in rents happening and just no relief going forward. A wave, and that's probably understating it, of new entrants coming into our housing markets from overseas. And we're seeing a collapse in new building exacerbated by record building costs. And as I said, I think obviously as governments should assist the marginalised. And we saw that in the recent federal budget to some degree. But, as far as trying to change the whole box and dice in terms of the system, good luck with that, because it will take you quite a long time, I think. And unfortunately, you do get a number of ideologues involved in government that tunnel vision towards redoing the world, redoing the planet, redoing the system. And they probably don't care that much about the stress that it causes in the shorter term if it means they get sort of loopy policies enacted in the long term, or their loopy view of the world realised over the longer term. So, tougher times for tenants are coming up, believe me, Michael, regardless of what governments do.
Well, even just recently, the Victorian Treasurer seemed to be bowing down to the Greens, suggesting he's going to consider rental freezes or rental curbs.
Well, I think there's some legal implications to that. You can't restrict the income of a private sector enterprise and then say, well, bad luck, you've got to pay all your extra expenses or rising expenses such as interest rates. Landlords, they vote. A lot of them are in those sort of meaty middle band suburbs too. I'd be a little careful about how they tread with the electorate. It's been a lovely ride so far for the Victorian Labor government, but all good things come to an end, and beware fiddling with property taxes and fiddling with, I guess, the ethos of private property investment, which has really supported this country through generations and through different migrant waves that are attached to that mantra. So they might be in for a little bit of a shock, but unfortunately, of course, there is the leverage of those fringe parties such as the Greens. So governments have to listen to that if they want to govern.
Now, we're almost halfway through the year, the end of the month, and in a couple of days' time, we'll be looking forward to My Housing Market's monthly market updates. But another thing is going to happen at the beginning of the next month also. The Reserve Bank's got to sit down and decide what it does to interest rates. And recently, the minutes of the last meeting showed the decision last month was very close, Andrew.
I thought it was very interesting. When we got the statement on the day, Michael, it was quite adamant in terms of a concern about inflation, that inflation looked to be deteriorating, that it had shifted from inflation for goods to inflation for services. This was an overseas trend that was also of concern. So the Reserve Bank was using this as their mainstay for raising rates again. I thought with that statement on the decision day, that they were really saying, hey, look, we're getting tougher here. We're really going to focus on inflation going forward. We're more concerned about inflation. And I think we discussed that at the time, Michael, that it just did look like they'd hardened their stance. The minutes released last week from the meeting, Michael, and that actually told us a different story. It showed that the decision was quite close, that they said that they were finally balanced between a pause and an increase. The case for the increase was, as we've stated there, continued concern over inflation, particularly services inflation, which was being driven by, wage increases and a lack of productivity supporting those wage increases. And on the other hand, there was an argument, and they said a strong argument for a pause because they were concerned that the impact of interest rates wasn't being revealed as yet, that there was a lag, and that perhaps there was a danger that the economy would suffer from higher interest rates, and the Reserve Bank wasn't, in a position to be able to view that because it takes some time for those effects to be revealed. So it was between, hey, we might have gone too hard, we need to see how it's affecting the markets, and B, hey, we've still got to control inflation. And it looked like the B's won, which was, obviously a higher rate, concerns over inflation. The Reserve Bank did say that even though the data's still been very, very strong, and we've discussed that, particularly in terms of the labour market, and of course they were unequivocal this month about, yes, the housing market, house prices are rising again, which they must have said through gritted teeth given their doom and gloom predictions, but just another revival of opinion from the Reserve Bank regarding housing markets, or change of opinion. But I think that the issue was consumer consumption, and they were pointing at the retail sales data, which was flat over April. We do get the May data out this week, Michael, for retail sales. That will be very interesting to see whether that consumption measure, which is important to the Reserve Bank, of course, retail sales shows us what we're spending, does continue to deteriorate. It's still very high, but certainly the trend has been weakening. And if that continues, I think that that's going to shift the argument in favour of those that want to pause. So I think maybe we've got certainly a stronger, the odds are narrowing that we may get a pause sooner or later, but of course it will rely on the data. The data will come through this week for May, but having said all that, even if it is another weakening trend, I wouldn't be surprised if it's a higher trend. Now, I'm not saying it's going to happen, but we have seen a lot of issues with the seasonal adjustment models from the ABS, particularly with the labour market up 1 month, down the next. And I think that ABS has admitted that it's having some issues with its seasonal adjustment measuring as a result of COVID. We need to look at the retail sales to give us a sign of whether we'll get a pause in interest rates for the July meeting. So it should be a very interesting data set. But as I said, we've still got to think about, are there issues with seasonal adjustment? But I think the Reserve Bank will take the data as it is. If it is weaker, I think that certainly is increasing the chance that we'll get a pause in interest rates over July. And we might get that anyway because they were so close over June. And let's also remember, and I'll finish up with this, Michael, that the US have paused interest rates now, first time since January last year. New Zealand has said it's not going to raise rates again, even though their rates are significantly higher than ours, and they are in a recession. But perhaps, quid pro quo there. So there's certainly the drums are beating that we may get a pause sooner rather than later, which is good news for mortgage holders, but the data will be important that is released this week.
Well, we'll know in a week's time what's going on. Now, we regularly report the My Housing data, capital city property market statistics, but sure, there's people living all over Australia, and
Yes.
I know that you look at all Australian property regions.
Yes.
So what's happening in the regional markets at present?
Well, some interesting stats with our latest regional market breakdowns, and these are the major LGAs of New South Wales, Victoria, Queensland, and the LGAs of the Northern Territory, which there are really two major ones, the Darwin ones, and Tasmania. But interestingly, we've seen strength in the lower price sections of the market in New South Wales over the past 2 years. Michael, no surprise, I guess, affordability and COVID driving more demand into those areas. Albury median house prices up by 20% over the past 2 years, Dubbo up 32% over the past 2 years, and Wagga Wagga up 31.9%. Of course, they typically have lower medians than the LGAs closer to the seaboard. Similar story in Victoria with some exceptions. Bendigo's really broken away from its relationship with Ballarat in terms of growth, although the medians are quite similar. Bendigo median house prices up 16.7% over the past 2 years. Latrobe, of course, which along with Shepparton is the most affordable LGA, regional LGA in Victoria. It's had a 21.5% increase over the past 2 years. Strong growth there. Of course, these growth numbers aren't as strong as the New South Wales regions, but nonetheless, I guess the exception to this is the Surf Coast, which has had an 8.4% increase over the past 2 years. Nowhere near Latrobe and Bendigo, but still, I think, reflects particularly some of that. And of course, the Surf Coast is really a boutique market down there to the southwest of Melbourne. But perhaps there was certainly increased demand through the lockdown period. In Queensland, we saw Bundaberg, Fraser Coast and Toowoomba up strongly over the past 2 years. And Noosa was actually a strong performer. And we know there was a lot of demand into the Noosa Heads market as a result of lockdown. And it actually had an increase of 46% over the past 2 years in its median house price. Fraser Coast, of course, which is north of Noosa, up by 42%, and Bundaberg, also north of Noosa, up by 40%. So some very big numbers there. Those perhaps fleeing lockdowns for those Queensland regions. And if we look at Tasmania, top performer was Launceston, up by 16.4%, and Glenorchy up 10.9%. And Palmerston just shaded Darwin in the Northern Territory, up by 5%, Darwin up 4.3%. So just a quick snapshot there, Michael, of what we've seen in our major LGAs over the past couple of years.
So the 2-year statistics have been great for most of those regional areas, but if you look more recently over the last quarter, over the last year, they've suffered just like the capital cities have, Andrew.
They have, and there's always a lag between the capital city and its adjacent LGAs, more or less. I would expect, because we are certainly seeing a revival in all of our capital cities at the moment, that we would see those regions follow on sooner rather than later. So it will be interesting to see how those LGAs respond, and it'll also be interesting to see how they respond if we do get a pause in interest rates over July.
I just wanted to interrupt this week's Property Insider chat to remind you this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat with you to help you take advantage of the new property cycle. If you think about it, an opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and your options? Remember, we've got no properties for sale, but we offer strategic advice to give you directions, results, and certainty. This is the right time to get all your ducks in a row and get set for the opportunities that are going to abound. But be careful. Property investment is a process. It's not an event. So you can't just go off and buy any property and hope to be successful. Formulating a plan and getting the right advice is more critical than ever now. So why not have a chat with the team at Metropole? Go to metropole.com.au. Well, the auction markets this weekend had two things to contend with. First of all, it was winter and it was cold, but it was also school holidays.
Yes.
So there were fewer properties put up to auction. But how did they perform?
Well, it is the beginning, I guess, in reality, of the winter selling season, which of course is the hiatus between the autumn and spring, which of course is logical, but because winter does come between autumn and spring. But the selling seasons are created through those holidays that have those mid-year holidays. It's been a very strong autumn selling season, of course, a season of revival. It's now showing signs of now morphing into the winter selling season, where we have fewer buyers and sellers. They are distracted, lengthy school holidays. And what happens during this period of the next month or so, Michael, is that buyers and sellers start to think about a spring campaign, and that starts to evolve through August. So we're in that mid-year period now. It has begun, as I said, after strong results. Now, it was interesting that, school holidays have started in Melbourne and Brisbane this week, New South Wales, Adelaide and Canberra next weekend. So they've yet to come, but we certainly saw a falling away of auction numbers as a reflection of the ongoing or oncoming holiday period. Clearance rates really stood up everywhere, Michael, except for Sydney, where we saw clearance rates fall to their lowest level for the year at 69.1%. But there was just 423 auctions, so not a lot of auctions, and well down on the 81% previous weekend, which was a bounce back following the Queen's birthday holiday, so we're a bit all over the shop. Melbourne numbers down, but clearance rates were up in Melbourne despite the commencements of school holiday. Brisbane also higher clearance rates. Adelaide, similar auction numbers and a higher clearance rate, and Canberra again similar and a higher clearance rate, but they're yet to move into holiday mode. But certainly the signs there of the winter season coming through, Michael. And of course, what we do see during winter is typically lower clearance rates and lower prices, and that's only because we see a much higher proportion of lower priced properties in the marketplace, mid to higher priced properties, sellers are engaged in holidays. So we don't see the numbers that we see in a normalised market, and we have to wait till spring for that to eventuate or to evolve back into more of a normal balance. So we've had a good start to the year, Michael, if you're a property seller, and a buyer if you're still buying at a discount with prices. And I guess there's some reasonable anticipation of a good spring selling season, particularly if we get a pause in interest rates.
Well, that'll be interesting to see. I look forward to catching up with you between these regular Tuesday Property Insider chats with the end of month statistics, which will be out on Friday, the 30th of the month.
Yes, and I guess we're the first. And of course, as we know, because we report rolling quarters on a month-by-month basis, we have a significant number of observations to report on. So we have quite a reliable data set there to view. But notwithstanding all that, our data really reflects what everybody else is saying, other data sets, but we're out earlier.
Catch up with you in a couple of days, Andrew. Thank you.
See you, Michael. Bye.